Since the outbreak of COVID in early 2020, China's economic growth has slowed down, and consumption has continued to decline. At the end of 2022, China lifted the pandemic control policy, the economy and consumption seemed to gradually begin to pick up after a short and full-scale spread. In particular, the recovery of various data and indicators during the 2023 Spring Festival boosted people's confidence in the economic rehabilitation. Recently, economists from UBS, Goldman Sachs, Deloitte, and other institutions projected a gradual recovery of China's economy, with its GDP grow by 5.4% in 2023. Goldman Sachs research team raised the estimated 2024 GDP growth rate to 5.2%, higher than the IMF's previous forecast. This video helps clarify key issues, analyze market in depth, and better seize business opportunities. Before 2019, the annual household consumption rate was basically stable at around 70%. However, due to the impact of pandemic, the consumption rate has declined significantly since 2020. After a brief rebound in 2021, it fell again in 2022 under the repeated impact of pandemic. In the 3 years since 2020, China's consumer spending has been reduced by more than 3 trillion yuan. Nearly half of that fell in 2022. From the perspective of expenditure structure, the proportion of consumption closely related to social travel scenarios, such as transportation, education, entertainment, and apparel decreased significantly in comparison with 2019. In addition to daily consumption, spending on housing was reduced by about 3 trillion Chinese yuan in 2022. Data from the National Bureau of Statistics show that in 2022, China's online retail sales reached 13.8 trillion yuan. An increase of 4.0% over the previous year, amid a general trend of decline in the total retail sales of consumer goods. During the pandemic, the convenience of online shopping has made itself a more common way of shopping and a channel for businesses to acquire customers. According to McKinsey's 2023 survey of Chinese consumers, 58% of urban households surveyed are willing to put money away for a rainy day. China's per capita disposable income rose 2.9% in real terms in 2022, basically in step with economic growth. According to National Bureau of Statistics, in the first 9 months of 2022, household deposits grew by 14 trillion yuan. In January 2023, household savings increased by 6.2 trillion yuan, a record high for the same period. In terms of foreign trade, although exports played a significant role in driving China's economic growth in 2022, facing the global economy downturn in 2023, accompanied by trade decoupling and industrial chain shift, the external demand will continue to fall and exports are likely to drag down China nominal GDP in 2023. The structural divergence between different regions reflects local governments' estimate on the macro trend this year. According to the work reports released by the 31 provinces before the 2 sessions in March, most remain conservative expectations on 2023 economic growth, and the weighted average GDP target is merely 5.6%. Hainan expected the highest growth, while Jiangsu and Qinghai expected the lowest. Zhejiang, Jiangsu, Guangdong, and Shandong, the 4 major foreign trade provinces, all had lowered their GDP targets compared to 2022. In the face of rising savings rate, downward trend of consumption, and external demand, the government work report of 2023 2 sessions proposed to focus on expanding domestic demand and give priority to the economic recovery and boost consumption. Centering on this theme, a series of economic stimulus plans and policies will be introduced to form a strong domestic market, promote innovative development of foreign trade, intensify efforts to attract and utilize foreign investment, promote high-quality development of free trade zones, optimize layout of regional opening up, raise the level of outbound investment and economic cooperation. The overall message of the 2 sessions is to avoid overstimulating the economy and to restructure the government for long-term development. According to the economic data of the first 5 months of 2023 released by National Bureau of Statistics on June 15, the overall economic operation shows a trend of stabilization and recovery, which is reflected in: first, production demand is picking up in both the industrial and service sectors, leading to improved consumption and investment demand. The total retail sales of consumer goods in the January to May period increased by 9.3% year-on-year. while fixed investment increased by 4.0%, among which high-tech industries grew rapidly. From January to May, the industrial added value of enterprises above designated size increased by 3.6% year-on-year, indicating steady growth of industrial production, among which the equipment manufacturing industry grew rapidly. Second, employment and prices were generally stable. The surveyed urban unemployment rate of May was 5.2% on average, unchanged from April. The Consumer Price Index, CPI, rose by 0.8% year-on-year among the world's major economies. China is with generally stable prices in sharp contrast to high global inflation. Third, the economic cycle extended the recovery state. In addition to the production and consumption end, some indicators of transportation such as freight volume, the passenger business activity index of railway and air are above 60% of the high boom range. The economic target, GDP growth of 5% by 2023 announced during the two sessions, is a lower than expected, but more achievable target and more sustainable for long-term growth. The economy of China is still in the initial stage of recovery, with some prominent long-term internal structural problems, and the global environment remains complex. However, Citibank economists believe that geopolitics' impact on markets will be relatively little for now due to the strong recovery potential of China's economy. According to JP Morgan, consumption will contribute 4.1% to the economy in 2023, while investment will contribute 2%, providing more support to GDP growth for the whole year. Looking to the future, the survey results of various institutions show optimism and confidence on China's future economic development and consumption willingness. They believe what drives China's growth recovery in 2023 is likely to depend more on a recovery in the consumer sector and the strength of infrastructure investment spending. China is still a favored place for investment. With the further opening up of pandemic control and policy stimulus, market confidence will gradually return. Asset allocation behavior will change with the excess deposits flow to businesses, stock markets, real estate, wealth management and other assets, thus further drive the employment of the industry and recovery of the economy. In the expansion of consumption segmentations, research shows that consumption sectors most restricted by the pandemic, such as tourism and entertainment, will have the greatest room for recovery. The China Tourism Academy estimates that domestic tourism of 2023 is expected to recover to 71%, and the number of inbound and outbound tourists is expected to recover to 31.5% of the pre-pandemic level. China markets start 2023 with a bang as policy shift hastens. For brands, the 3 months around the Chinese Spring Festival are generally a consumption off-season. For investors, China's economic indicators are expected to rise in the second quarter. However, after a sharp month-on-month decline in April, the latest data, released by the People's Bank of China on June 13, showed that loans increased by 1.36 trillion yuan in May, continuing the overall slowdown since April. The amount of social financing increased by 1.56 trillion yuan, better than in April. From a structural point of view, compared with the negative growth in April, the newly released data of May indicated that RMB credit and social financing scale resumed growth, but the performance is still weak. Investment strategies are suggested to focus on the theme of economic recovery and those verified with the quarterly forecast, such as the large consumer, technology sectors, in addition to identify specific investment opportunities in sustainable development areas, such as the digital economy, advanced manufacturing, medical innovation, and renewable energy that are expected to be promising in the future. It's also important to have a globally diversified portfolio of investments in high-quality, non-cyclical sectors with big potential of increased earnings and valuations. According to McKinsey's 2023 report, 5 trends are reshaping the Chinese market. 1. The rising middle class. 2. Premiumization maintains momentum. 3. Smarter choices instead of trading down. 4. It's all about the product. And 5. Local companies are winning. These will have a profound impact on many fast-moving consumer goods companies, including apparel, cosmetics, and food. For increasingly rational consumers, it's critical for brands understand local consumers' purchasing behavior, consumption pattern, and leisure habits, as well as their attitude towards life, success, wealth, and health, thus to provide added value and better experience. As the global economy transitions to a low-carbon future, and green lifestyle is increasingly integrated to awareness of consumers, it is in the best interests of companies integrate green development into their corporate and marketing strategies to gain the recognition of consumers. Planning on the industrial chain cluster of durable consumer goods in line with the direction of future industrial changes will take the lead in global competition. At the same time, compared with the traditional business model in China market, the channels of communication to users have undergone upgrading and dramatic changes during the pandemic. Redesign the models of how to effectively reach users has become a top strategic priority to win the Chinese market with more than 400 million middle-class consumers. For multinational companies, continuously develop customized products, getting close to Chinese consumers, and finance their high R&D with big sales in China market is one of the primary considerations to maintain global competitiveness.